Hey guys, this is Vyom Joshi with Superior North. Welcome back to my channel. Today we will be talking about Seneca Foods. Seneca Foods provides packaged fruits and vegetables. The company's offerings include canned, frozen, and bottled produce and snack chips. In this video, we will be going over the company's annual report, then review the company's fundamentals by going over its key ratios, and finally find the intrinsic value of the company. So let's dive in and review Seneca Foods.
Hey guys, let's start off by looking at the Form 10-K, which is the annual report that Seneca Foods Corporation filed with the SEC. This is for the fiscal year that ended March 31st, 2021. And on page 5 of this report, the company provides us a business overview. Seneca Food Corporation is one of North America's leading providers of packaged vegetables with facilities located throughout the United States. The company's product offerings include canned, frozen, and bottled produce and snack chips, and its products are sold under private label as well as national and regional brands that the company owns or licenses, including Seneca, Libby's, Aunt Nellie's, Reed, Green Valley, and Cherryman. The company also states that its facilities consist of 22 packaging plants strategically located throughout the United States, 2 can manufacturing plants, one of which also packages, 3 seed packaging operations, a farming operation, and a logistical support network. Next, on page 7 of this report, the company talks about the seasonality of its business. The company states that minimal food packaging occurs in the company's first fiscal year ending March 31st, which is the optimal time for maintenance, repairs, and equipment changes in its packaging plants. After that, the company says that the timing and amount of company sales and earnings are dependent on the supply of commodities, current pricing, and expected new crop quantity. The company then describes its inventory pattern by saying that when the seasonal harvesting periods of company's major vegetables are newly completed, inventories for these packaged vegetables are at its highest levels. For peas, the peak inventory time is midsummer, and for corn, which is the company's highest volume vegetable, the peak inventory is in mid-autumn. In this table below, the company breaks down its financial information based on each quarter. We can see that for the year 2021, the third quarter brought in about twice as much net sales as it did in the first quarter. Next, on page 10 of this report, I wanted to briefly go over one of the risks that the company talks about, where it says that it is dependent upon key customers. Over here, the company explains how the top 10 customers represent approximately 50% and 49% of its net sales for 2021 and 2020 respectively. So if it loses a significant customer, or if sales to a significant customer materially decreases, its business, financial conditions, and results of operations may be materially and adversely affected. On page 59 of this report, the company talks about its segment information. The company manages its business on the basis of 3 reportable segments. The primary segment is its fruit and vegetable segment. Second is its prepared food segment. Third is its snack segment, and then it lumps everything else in the other products segment. The company markets its products almost entirely in the United States, and export sales represent 6.5% of total sales in both 2021 and 2020. In this table below, we can see that for the fiscal year 2021 and 2020, lion's share of the company's net sales came from its fruit and vegetable segment. When we look at the prepared food segment, we saw that the net sales dropped off, which makes sense because due to the pandemic, as people stayed indoors, they cooked meals themselves, and hence the demand for its prepared food segment dropped off in the fiscal year 2021. However, overall, the company's net sales saw an increase in the year 2021 when compared to that of 2020. Now that we have a brief understanding of Seneca's business and its reportable segments, let's review the company's fundamentals by focusing on its key ratios. Hey guys, I'm on Morningstar looking at Seneca Foods Corporation. Seneca Foods actually has 2 different classes of common shares, Class A and Class B. Class A has 1 share equating to about 1/20th of a vote, whereas Class B, 1 share equates to 1 vote. Looking at the key ratios, I'm on the financials. The first item on the list is the revenue. The revenue is the top line of the income statement. This is the amount of money that the company brings in via sales. Back in 2012, the company's revenue was about $1.3 billion. And for the year 2021, it was about $1.5 billion. Over the past 10 years, the company's revenue has stayed steady and has been increasing ever since 2019. Next, looking at the operating income. The operating income is what's left with the company once we subtract the cost of goods and operating expenses from the company's revenue. Back in 2012, the company's operating income was about $26 million. And for the year 2021, it was about $181 million. Ideally, we want to see the company's operating income to have a similar trend as the company's revenue. There was one unique year back in 2019 when the company's operating income was a negative number. This happens when the company's cost of goods or operating expenses exceed the company's revenue. However, apart from this unique year in 2019, the company's operating income has always been positive. Next, looking at the net income. The net income is the bottom line of the income statement. This is the amount of money that's left with the company once it pays for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes. Back in 2012, the company's net income was about $11 million, and for the year 2021, it was about $126 million. We can see that for the fiscal year 2019, the company's net income was positive. However, the company's operating income was negative. This means that in the fiscal year 2019, the company probably sold off some of its non-operating assets, which is why even though the company had negative operating income, it ended up reporting a profit because it sold off some of its assets. Over the past 10 years, there was only 1 year back in 2018 when the company reported a loss. Ever since then, that is from 2019, the company's net income has been positive and trending upwards. Next, Seneca Foods does not pay out any dividends, and it's likely that the company will not be paying out any dividends in the future, as in order for the company to pay out any dividends with a small cap company like this, they have to get with their credit agency or their financial institution and get their approval in order to ever pay any dividends. So it is unlikely that we would be seeing any dividend payments in the future. However, as shareholders, we do want to see the company buy back its shares. And when we look at the shares outstanding numbers, we can see that the shares outstanding numbers have been decreasing, which tells us that the company is buying back its shares. And this buyback actually helps increase the existing shareholders' ownership within the company. Next, looking at the book value per share. The book value is what we get when we subtract the company's total liabilities from its total assets. So essentially, the book value is the same as the shareholders' equity. Back in 2012, the company's book value was about $30.85 per share. And for the trailing 12 months, that number was about $67.51 per share. When it comes to book value per share, it's important that we also look at the company's balance sheet, as we want to see the company's plant, property, and equipment to have proper depreciation associated with it. Because if the company does not depreciate those assets properly, then we could see inflated book value numbers. In the case of Seneca Foods, the company has depreciated about 55% of the company's plant, property, and equipment that it has reported on its balance sheet. And in the past, the company's accumulated depreciation has ranged between 50 and 70% of the company's total plant, property, and equipment. Finally, looking at the free cash flow. The free cash flow is what we get when we subtract capital spending from the company's operating cash flow. Ideally, we want the company's free cash flow number to be positive, staying steady, or increasing. Since 2021 was such a unique year, I will be using the 2020 free cash flow number of $62 million for my discounted free cash flow DCF analysis. Now let's look at the profitability of the company, focusing on the net margin. The net margin is the ratio of the company's bottom line to its top line. So it compares the company's net income to its revenue. Back in 2012, the company's net margin was about 0.89%, and for the year 2021, it was about 8.56%. What this means is every $100 that the company made in the fiscal year 2021, by the time it paid for its cost of goods, operating expenses, non-operating expenses, interest on its debt obligations, and taxes, it had about $8.56 left as pure profit. After that, looking at the return on equity, the return on equity is the ratio of the company's net income to its shareholders' equity. Warren Buffett prefers to only invest in securities that have a return on equity of 8% or greater every year for the past 10 years. Back in 2012, the company's return on equity was about 3.23%, and for the year 2021, it was about 25.87%. The three ways in which a company can increase its return on equity number is first by making more money, by increasing its net income. Second is by buying back its shares. And third is by taking on more debt that is becoming more leveraged. Next, looking at the return on invested capital. The return on invested capital gives us an idea of how good the management is at allocating the company's capital and getting a return on that investment. Back in 2012, the company's return on invested capital was about 2.83%, and for the year 2021, it was about 17.95%. Seneca Foods' weighted average cost of capital, also known as the company's hurdle rate, is about 4.64%, and since the company's return on invested capital is greater than its weighted average cost of capital, we can safely say that the management is creating value for its shareholders. Finally, looking at the interest coverage. The interest coverage is the ratio of the company's income to its interest obligations. So it gives us an idea of how many times can the company pay off its interest obligations using its income in that calendar year. Back in 2012, the company's interest coverage was about 3 times, and for the trailing 12 months, that number was about 26 times. Benjamin Graham, the father of value investing, preferred to only invest in securities that had interest coverage of 5 times or higher. Now let's look at the financial health and liquidity ratios. The first item on the list is the current ratio. The current ratio compares the company's current assets to its current liabilities. A current ratio greater than 1.0 tells us that the company has enough assets to fulfill its liabilities over the next 12 months. Ideally, we want the company's current ratio to be greater than 1.0. It's even better if it's greater than 1.5. Back in 2012, the company's current ratio was at 4.60, and for the latest quarter, it's at 2.10. Next, looking at the quick ratio. The quick ratio is similar to the current ratio, except we disregard the inventory component. In other words, quick ratio is equal to current assets minus inventory divided by current liabilities. Ideally, we want the company's quick ratio to be greater than 1.0, as it tells us that the company does not have to rely on selling its inventory in order to fulfill its current liabilities. Back in 2012, the company's quick ratio was at 0.82, and for the latest quarter, it's at 0.44. So the company's current and quick ratio tell us that the company is not in a liquidity bind in the sense that the company has enough current assets to fulfill its current liabilities. However, it does have to rely on selling its inventory in order to fulfill its current liabilities. After that, looking at the financial leverage. The financial leverage is the ratio of the company's total assets to shareholders' equity. A financial leverage of 1.0 tells us that all of the company's assets are financed by its shareholders' equity. And a financial leverage of 2.0 tells us that half of the company's assets are financed by shareholders' equity and half of them are financed by its liabilities. A higher financial leverage tells us that more of the company's assets are financed via liabilities. Back in 2012, the company's financial leverage was at 2.12, and for the latest quarter, it's at 2.02. Over the past 10 years, the company's financial leverage has stayed fairly consistent. Finally, looking at the debt-to-equity ratio, this ratio compares the company's total debt to its shareholders' equity. Ideally, we want the company's debt-to-equity ratio to be less than 1.0. It's even better if it's less than 0.5. Back in 2012, the company's debt-to-equity ratio was at 0.65, and for the latest quarter, it's at 0.33. The company's financial leverage and debt-to-equity ratios tell us that the company is living within its means. In other words, it is not taking on more debt, more liabilities in order to finance its growth. Now let's look at the efficiency ratios. The first item on the list is the days sales outstanding. This number gives us an idea of how many days go by from the day the company recognizes the sale to the date it actually receives cash for that service rendered. Back in 2012, the company's days sales outstanding was about 22.5 days, and for the year 2021, it was about 25 days. Ideally, we want the company's days sales outstanding number to be staying steady or decreasing. What we do not want to see is a company whose days sales outstanding number is growing rapidly, as it tells us that the company is being aggressive with its accounting. That is, it is aggressively recognizing its revenue sooner so that it can inflate its income numbers on its income statement. However, Seneca Foods' days sales outstanding number has stayed fairly consistent, and the management does not seem to play any such accounting tricks. Next, looking at the days inventory, this number gives us an idea of how many days does the company's products sit in its inventory before they're sold. Back in 2012, the company's days inventory was about 138.6 days, and for the year 2021, it was about 111.5 days. Ideally, we want the company's days inventory number to be staying steady or decreasing. What we do not want to see is a company whose days inventory is growing, as that means that the company's inventory is just sitting around on its balance sheet. We rather see that company's inventory pushed onto the income statement and flow and become a profit at the end. So it's encouraging to see that the company's days inventory has been decreasing since 2019. Finally, looking at the payables period, this number gives an idea of how many days does the company take to pay its suppliers. Back in 2012, the company took about 20 days to pay its suppliers, and for the year 2021, it took about 21.5 days to pay its suppliers. Ideally, we want the company's payables period to be staying steady or decreasing. What we do not want to see is a company whose payables period is growing rapidly, as it tells us that the company may be holding on to its cash in order to artificially inflate its cash flow numbers on its cash flow statement. However, it seems that the company's management is not playing any such accounting tricks when it comes to their cash flow numbers. Now let's look at Seneca Foods' current valuation. The first item on the list is the price to earnings ratio. Seneca Foods' PE is at 3.8. The company's price to book is at 0.7. The company's price to sales is at 0.3. And the company's price to cash flow is at 9.2. So we can see that on an absolute basis, Seneca Foods is an undervalued security. The company's price to cash flow is a little elevated compared to its 5-year average. This is because of the time of the year. The company's cash flow is a smaller number because it did spend a lot of money on its inventory, leading to a smaller cash flow number, which is why the company's price to cash flow at this moment is elevated. And finally, when we look at the S&P 500, an S&P 500 is the aggregate of the top 500 companies in the United States, and we can think of S&P 500 as our opportunity cost. We can see that on all the valuation metrics, Seneca Foods is undervalued when compared to the S&P 500. Hey guys, now let's look at Seneca Foods' discounted free cash flow DCF analysis. Over here, I pasted the company's 2020 free cash flow number that I got from Morningstar, which was at $62 million. I'm assuming the annual growth rate of free cash flow to be 5%. What this means is I expect the company's free cash flow to grow at 5% every year for the next 10 years. I'm using a discount rate of 10%. What this means is I want this investment to give me a 10% return. I'm using a long-term growth rate to be 1.9%. What this means is after the 10-year mark into perpetuity, I expect the company's free cash flow to grow at 1.9%. This 1.9% is in line with the US 30-year Treasury yield. Next, the company has 9 million shares outstanding and has a long-term debt of $94 million. After taking all of these inputs into account, we get the company's intrinsic value to be about $95 per share. And when we compare this intrinsic value to the company's current stock price, which is at $47 per share, we can see that the company's current stock is trading about 50% below the company's intrinsic value. The way we calculate this intrinsic value is we look at what the free cash flows would be every year for the next 10 years. We sum up all those free cash flows, which come out to about $484 million. Then we look at what the free cash flows would be after the 10-year mark into perpetuity. We sum all those up to get the intrinsic value to be about $952 million. From this number, we subtract the long-term debt and divide by the shares outstanding to get the intrinsic value per share to be about $95 per share. Now, if we disregard the perpetuity component, in other words, if you think that Seneca Foods is only going to grow for the next 10 years and then it'll cease to exist, then we get the intrinsic value without perpetuity to be about $43 per share. If we disregard the company's debt, in other words, if you think that Seneca Foods is going to grow into perpetuity, so there's no point to worry about paying off its debt, then we get the company's intrinsic value without its debt to be about $106 per share. Finally, let's try to figure out what kind of annual return can we expect to get on this investment if we were to purchase the stock at the current stock price. We can run a what-if analysis, do a goal seek. We can select our intrinsic value to equal the company's current stock price by changing our discount rate. What we get is, if you were to purchase the company's stock at the current stock price, we can expect to get an annual return of about 16% on this investment. Overall, we saw that Seneca Foods has good fundamentals. The company is undervalued not only from an absolute basis, but also when we looked at the company's discounted free cash flow DCF analysis, we saw that Seneca Foods is an undervalued security. The packaging food industry is experiencing inflation, not only with its shipping, but also its packaging and raw materials. So in order to save costs, it is going through its shrinkflation phase, where it's cutting down on the size of its containers. So the next time you go to the grocery store, you may see that the can, the box, or the bag of your cereal, your chips, or whatever is now in a smaller container. So the food packaging industry is going through this phase where it's cutting down on its packaging. So rather than increasing its pricing, it is cutting down on its packaging and making sure that the end customer still sees the same price that it did previously. The food packaging industry is very fragmented, and as we saw earlier, for Seneca Foods, 10 of its largest customers account for 50% of the company's total revenue. So any lost contracts or any decrease in sales to those customers would impact Seneca Foods' bottom line. Seneca Foods' brand has a pricing power. However, in its annual report, it talks about how its products, in a way, are commodity-like, and it's constantly competing not only with other brands, but also its private label customers. Hey guys, that is all I had for you this week. Hopefully you found this video on Seneca Foods interesting. If you like this content, please do like, share, comment, and subscribe. And if you have any suggestions on which stock I should review next, please leave it in the comment section below. I'll greatly appreciate it. Thank you.